TGIF Warriors. Hello, Mike, Michael, AJ. Hello, team.
Morning, Dale.
Morning,
Morning, Coach.
Hey, guys. So the ECB did bail out Euro bulls. Nice call, Ryan.
Thanks,
on
Mike.
that. Hope you were there. I mean, to me, it's tough to want to be long the dollar, but I found something. I'm making an attempt here at 61.8 in Aussie. Okay, so no change came in BOJ policy.
Absolutely nothing, and even dovish. He spent an hour later after the statement with a couple of lines where he leaves half a door perhaps open to something if prices warrant, but most of the time he's been really dovish. As I said,
do you have a level up around 143? Because that's some of the stuff I'm coming up with around there.
2.5. I've got some stuff. Actually, the whole way up from 141, call it 70, to up to 142.5. I've got some stuff. Yeah, it's put a lot of pressure on the yen again, and not only dollar yen, which is virtually the only one, which is higher today. But if you will look at the cross yen, it's an absolute explosion. He didn't give anything to yen bulls to stick their teeth in. Again, it could be the next meeting they start to talk about something, or they show something in the minutes. But himself, it was really. He even said that the side effects of yield curve control are less visible or fading or shallower or so. I mean, it's really, he hasn't given anything at all for
nothing to chew on. Yeah, not even thrown you a bone.
No bones at all. Not to me anyway. And the market's same.
Yeah.
So
so it looks like higher numbers are still coming despite dollar weakness, which might throw some people.
Yeah. I still got the impression that a lot is driven by the crosses yen. But yeah, undeniably, dollar yen is pulled up by it. But it's going slower than other dollars weakening.
Yeah, I just wanted to show a couple weekly charts. It is Friday, and I think I'll go to Ryan, who's been constructive cable all the way up.
Me too.
Okay, Kman too. That we're approaching.
And me too as well.
Okay, so the Three Musketeers.
Wait, me too. Me too.
Anyone not? It's the easiest question.
Well, I tried to sell Euro this week. It wasn't cable. It was a relative week. Didn't work. Anyway, do you guys have anything up at these levels? This is a 50 week coming in where 28.72. You have anything up there or levels above the market where it might be
130?
130?
Yeah, that's gonna be the biggie. Okay.
And then should this have been a dollar breakdown, and that's a pretty impressive candle in euro, 112?
Well, if it goes to 112, it's got to get through 111 first, and we know how solid that is right now. So
it's actually the biggest candle we've had since back here.
Yeah.
So I guess, I don't know if Greg is here, but if it was impulsive. Anyway, it was not a bear flag and euro. So 112 viable? Or do we have to watch it a few days to see, because this was news related? We stand pat and they tighten and Lagarde talks like a hawk. It's almost, if it couldn't rally under those fundamental conditions, why wouldn't it rally? So is the interest rate differential going to be the big story going forward now?
It is, because what might we have? We might have at least one more hike, maybe two more hikes from the ECB before they even think about dropping the the pause word into things. That still puts them roughly 1%, 75 pips below the Fed, depending whether they hike or not. But yeah,
I'm reading about recession in Europe, okay, and real weak growth, weaker than here. So if Powell made a mistake and Lagarde follows through, she's really sealing. I mean, if they are, go ahead. Yeah,
we're talking technical recessions. No one's seeing negative activity, like falling activity. It's different between having sub-zero growth for a couple of quarters or whatever.
Okay.
If it's running at minus 0.2%, no one's gonna put the bed over that. But we're not seeing wholesale collapse of economies. Nothing's going into the real negative. So demand is still there. It's just going to be pretty weak. So recessions, in my book, are not going to be anything we need to worry about. It's not an economic slump.
Okay. So does this do more rate hikes make the situation better?
No, probably not. Probably puts a bit more pressure on, but that's the mandate for the ECB. It's price stability. It's not economic stability. It's not jobs. It's price stability. Okay. So they've got to do what they've got to do. But it's also, they don't. It may come to the point they don't hike in July and they don't hike in September. The data will tell us that, but they've got to keep the message out that they're prepared to do that. Otherwise, the market goes and undoes all the hikes that they've done thus far. And that's what Powell did by raising the medium dots. Doesn't mean they're going to go there, but they're telling the market we will go there if we need to. We may never get there in a million years, but you don't want the market undoing all that work, or you just end up having to hike more to close that gap.
Okay, I think this is why Powell. This is why Powell paused.
Can I say one thing very quickly?
Sure. This
Hello.
is why Powell paused.
You're actually right on that. I think very important chart that regional banks. Just want to say we've established that there are a few pretty big and important market players who watch F.A.C.E. And suddenly everybody doesn't like everybody's dovish the Fed. Anyway, now I'm kidding, but it's interesting the price actually.
Yesterday, the two things you pointed out: manufacturing weakness and services strength, and we've been banging on about that for how long? To do with the PMI data. They do watch our shows.
I'm sure of it. I'm sure that every central banker across the globe hits that F.A.C.E. attendee button every morning. So, so Stel, really, you have to respect the reversal you had right off the breakout line in gold yesterday. I mean, that's really, you have a line in the sand now in gold. Is it? So the question is, probably just like the dollar, was this enough and now we're heading to new highs, or could we have one more failing rally up around 1980 to 2000 and roll over one more time? What do you think?
Oh, we had a line in the sand already, which was the previous lows, 1930, I think, or so, 32, whatever it was. We broke those in intraday, and then we came right back. So some stops definitely were taken. I used to say up until a couple of days ago, I think it's more than a 50-50 chance we actually break to the downside first before we go a lot higher. I'm not so sure now. I'm 50-50 the other way now, I think. But the good thing is that we know the levels now. Like you say, the line in the sand on, you have the trend line at the lows.
This is Blake's line. I forgot to write his name on it, but it's his line.
No one else. And I appreciate the recognition. Thank you.
All right. No one else in the trading universe.
I'm the only one that saw that. I saw it first. I saw it first.
There have been some people besides me copying that trend line. I know.
Wow.
Can I steal the line?
That's a good line.
It's guys to the flow show.
It is so funny.
I want to steal the line. It's going to be mine from.
Right,
it's so fun.
Take Dale, an option out of it.
It is hilarious. Though. It is hilarious when people do that.
Yeah. They do.
When people go, "Oh, that's my line," I'm like, dude, we're looking at a trend line, for crying out loud. We all
Yeah,
see it. It's not like,
yeah,
you know, some
yeah,
brain
they
surgery
do.
you're performing.
Those are technical analists.
Oh my God. You
Anyway,
took my line.
really? You're going to say that? People get very
we
anal.
are now going back to gold and silver. Gold 1985 is a very
Yeah.
clear resistance level. Also, silver 2450. We've talked about it for a while. If these go, they will probably go together, and we're now closer towards that. So, what's it going to take for metals to not break out? I think yields have to go higher. I think 10-year US has to go to 390 and potentially break above.
That's not going to happen.
But it's looking strong so far. But you know, these are markets.
Yields are rolling over, man.
Happen.
They're rolling over. They get through 360, then 330, then under 3% handle on the 10-year. So where will gold be if we go to 280 in the 10-year?
All-time highs easily.
Okay, so it's all yield, and and this is what's going to kill the dollar too. Even though rates will come down, yields in Europe will come down with it, but not to the same degree.
Potentially, yes. Same with the UK. I think UK is going to be higher for longer, but yields and the dollar are going to go together. They usually do. And I'm with you on the direction of yields. I was just hoping to see 390 in the 10-year US to get long some or short the yield, but didn't quite get there, unfortunately.
Yeah, close enough for
government work.
Yeah.
So, I was a dick for a tick, like we say.
Yeah, I've done it. And look at what's happening in TLT on the daily. Confluence of trend lines. We start getting through 104, you have to declare it a low. That's another reason why the pause is. I think it gives some of the weaker financial institutions a chance to maybe cut back on some duration or make their books look better. You say if we got a rally to 116 or something like that in the bond market. So I actually thought that the rate drop was going to be risk off. So far, it's just jet fuel. We'll see. But I thought lower yields were also going to be accompanied by a stronger dollar, you know, kind of like the liquidity thing. And that narrative, I think, fell apart yesterday. So we'll see. They do look good. And sometimes the jigsaw puzzle doesn't come out the way you think it will. So if you don't learn how to change your mind, you won't have any change left. So don't be stubborn. If yesterday this was an important inflection week, you may want to wait for a little bit more action to confirm it, not just assume it after one day, but be flexible, keep an open mind. I just want to, you know, one last thing that I know we never pay much attention to, but we've had huge turns in grains this week, and I think that our companies should build a silo and fill it with wheat and corn and beans. Okay, so here's wheat.
So far, we built a silo of knowledge. Maybe we should build a silo of wheat. You're right.
Yeah, this looks pretty good. Here's corn. You know, I was early looking for it in here. You know, sometimes there's one more jiggle. I think it's underway. There's corn. Buy breaks. You know, I'm not saying chase things. Here's beans. That can't be it. Down $1.15. Wow. Oh, maybe there was a crop report. I haven't seen a move like this. Beans down 8%. We'll see if that's for real. If it is, it's setting up I think, a good buying opportunity. But the wheat, you could kind of call it your extended Ukraine war play. And, you know, I just retweeted an article about, you know, the shortages, first with medicine, you know, a lot of things we don't have. And we're going to run out of, and also about the fact that we're already in, you know, kind of a tight food market globally, and it's only going to get tighter. I guess cornfields are, you know, impacted by Grande El Nino already during the growing season, but consider it maybe an alternative asset class that has no correlation to the market really, and you can't print it, right? So the Fed can't increase supply of these things. It's all Mother Nature. And a weak dollar isn't going to hurt grain, any kind of commodity price, but really could be jet fuel for grain prices. So just a little something off, out of the box from what we talk about. Check it out. I know there are ETFs on all of this stuff too. And this could be the beginning of, when people talk about a super bull market cycle, super cycle in commodities, they're not necessarily talking about gold. They're talking about mainly agricultural commodities. So they've really gotten cheap since the invasion. Take a look at it. Carryover stocks are low. And
Coach, sorry to interrupt. Take a look at DBA. That's a very kind of representative ETF.
Oh yeah, there you go.
Agriculture.
Yeah, DBA.
Yeah.
Yeah, I know. So that's agriculture too, right? That's
yes.
the A in it. So yeah, I mean, here's a way you could participate. So let's see how it's been acting.
So
wow.
There you go.
Yeah.
Clean breakout.
Yeah. You look at it longer term, I know it probably looks like it got away from you, but looks like new all-time highs for sure. This was just like, continuation, just, a little time correction. Go ahead, Blake. Sorry.
No, I just want to say,
the Midwest in me.
It's what's that?
It's just, I'm sentimental about the grains.
Spending
time in the cornfields at Northern Illinois University.
Well, that's what happens in Illinois, right?
Yeah.
So, I want to talk about, this. I want to talk about like the move that we saw yesterday. It was a really, obviously it was a big move. It stopped me out of a lot of my dollar positions when we saw that reversal. I didn't think, the euro really stretched its it really stretched its legs once we got that breakout, and once we broke above that 50% retracement, it just continued to go. But you saw it across the board, so you saw the dollar Canadian broke down through that support. We're obviously sitting on some pretty key levels here, and I wanted to take a step back because we are at a long-term 38% retracement, which, if the dollar Canadian, really starts to, move lower, we're going to see 130. So, but the dollar yen, breaking out, I think Kman, I think you posted a story, from Asia online, Nikkei online, something like that, with the BOJ. The BOJ, just Ueda just continues to stay the course. There's a lot of people that feel that the July meeting is going to be live. What are your thoughts there?
Well, that's we're going to jump from meeting to meeting. But the way he spoke, I don't think that July is July may be the sign where he speaks about their plans. But we will have to be I think it's in a couple of weeks. There's going to be the Bank of Japan minutes, right? See if they really spoke about something, because he didn't hint at much during the hour-long press conference that he had later after the Bank of Japan. He was actually still saying that the effect of, as I said earlier, the effect of YCC, the side effects are subdued, which is not the tone a central banker who is ready to change monetary policy should have. So I think for the time being, if he is faithful to his over kind of communication that I've been talking about, then we're not ready for July, but rather going into September or so.
Yeah, and so a lot of times there, you get these headlines after the fact, and you get like kind of corrections, if you will, or people like clarifying, and maybe the Ministry of Finance might pop in and rattle off a few things, which you're not getting any indication that that there's going to be any change. I want to point out the 6J, which is the yen futures, that is sitting around the 618, completing a equal leg move. This is obviously kind of a long-term chart, and I'm really carefully watching these levels. But I posted on Twitter yesterday a bunch of long-term weekly charts, and you have to go out to the ICE feeds, because they're ones that are going to provide you the most data. and you can see like we are approaching some really key weekly. This is the Aussie yen. Here, let me delete this really quick. I'm gonna just get rid of that. We're like literally on this trend line. If you look at the euro yen, very similar. The pound yen different because of Brexit really, put it, doesn't have that same look. Euro yen's right at this big, this trend line spawns back all the way to 1990. Where were you in 1990? I'm not asking, I'm asking you all in general. I mean, you think about how long term that is. There's the euro yen. Look at the dollar yen on the weekly chart. I mean, you can see how suppressed the yen has been, or how suppressed it's been for a long time. For a lot of the old school of folks remember when there was the euro or the dollar yen traded 300 yen, which is a long time ago, but back in the 70s. So there could be a lot of weakness really coming if we see a breakdown in the yen pair. And I wonder what that's going to bring as far as political pressures to Ueda, in the months ahead, because that is, some of the reasons why, from what I understand, that he is not really being super hawkish at this point. Anyway, I think the yen is going to be a very, very spicy one if we start to see continued yen weakness. Now, I'm still looking for the dollar yen to trade up to the 142.50 to 143 level. There's some big technical levels for the dollar yen, yeah, and so, but where does that take the euro yen, Aussie yen, especially when you're seeing this, broad-based dollar weakness? So it's just it minus the yen, right? Minus the dollar yen. So very, very interesting moves here. One of the other things that I think is worth noting is if you go to the S&P, we have reached the 161% extension of this is the 2023 previous range before
you
the
put
breakdown.
that up well over a week ago.
I was the first in the world.
You were on this one. You were, Blake.
That's my line. That's my line.
Nope. My fib, not yours. No, but the one thing I want to point out, just jokes
some
aside,
harmonic deal. It was
it is. It's a Gartley pattern, but which could continue to stretch. It could stretch out to the 78% retracement, which would be up here towards 45.50. I think we're in like that zone. But if you look at the channel, that's also drawn. We're up towards the upper end of the channel. You guys that have been around a long time, and I've been through a few bear markets in my career. What is the characteristics, Dale, of, and I'm asking you specifically because you've been around a while, what is the characteristics of a bear market rally?
Vicious rallies without a lot of follow through, which we've had follow through,
and they're super convincing, right?
Yeah, they are. They have me making an appointment with a psychologist. So
yeah, and it really, we're in that
I mean,
point.
even smart guys like Welsh, when they were starting to turn negative, I don't think initially, and everyone I follow, they were talking 4,300, 4,340. The very few talking over 4,400. Now they've stretched targets to 45. So, you got
Tom Lee from Fundstrat. We're in an expansion, and
yeah.
you got a lot of bulls, like really.
But all the bears are trying to justify and look for the next level that's going to be the right one. And they've had to keep readjusting targets to the upside.
Yeah. And so the thing is, can we find some sort of turn here? Yeah. And this is like a conversation we've had on the Morning Edge and Daily Roundup really over the course of the last week is, you've got to wait for the turn, and you can't, you got to look at the candles. You got to start looking for reversal, reversal days with follow through and lower highs and lower lows. And we're not seeing it. I mean, that's the bottom line. You get these setups and it's like, no, that's not the right time. No, that's the candles are not suggesting that. You can get a doji up here, but then if you're not getting a follow through to the downside, you're not getting an evening star. You have to start seeing some sort of reversal take place. And until you see, the old saying, until you see the whites of their eyes, you have to assume that we're going to go higher. And so is this the high today? Probably not. It looks like we're going to continue to stretch our legs towards, 4,500. And I wouldn't be surprised if we see that next week. Look at Friday. I mean, today is Friday. It's at the end of the week.
No problem.
You look at the cable breaking out. It was the best performing, of the dollar, shorts, like I said on the week ahead video, and I wish I would have bought the cable. I played the pound New Zealand and yeah, I made a little bit, but it didn't make up for all my other losses in the dollar, and I wish I just would have played the cable to the long side, because it has looked really the best, dollar short really out there in G10, and you can see it just exploded above that resistance. And you look at charts
that helped the
this.
risk too. Like a weak dollar doesn't hurt the cause.
Yeah, I mean, well, no, it doesn't. But you continue to see, like we're on a Friday, we're going to get a continued melt up, because who wants to be short risk and who wants to be long dollars right now? No one, right? So, why shouldn't that continue? And you see the dollar Canadian just, breaking down. Yeah. We held up all night, held up all in Asia, but this is just a bearish consolidation, right? A bearish consolidation. And now we're getting the follow through, because you got everybody in North America getting up saying, damn, that thing can't rally. Get out, sell it, let's short it. That's exactly what we're getting right at this moment. Now that, are we going to get continued follow through throughout the rest of the day? My assumption is, yeah, why not? Because who's going to want to stand in the way? No one, not on a Friday, not as liquidity starts to get really poor. So anyway, I just want, yeah, go ahead.
Me.
Oh, you. I mean, yeah. It's as traders, we tend to be counter trading and stuff, and we try to scalp going other directions, and that's what we do. But I'm just talking like, the bigger money, the bigger flow right now.
Yeah.
Now,
there's a bit of a level here, 132, 132.10. Whether it lasts or not, I don't know. I've got a little scalp off the level. You got to trade the text, right?
Well, yeah. Look, this is like I said, 38% retracement. We're here. So, will we trade on both sides of that 132 level? Yeah, we might. But I'm just saying, like, I'm talking, and by the way, I hadn't looked at the trades room yet today, Ryan. so just FYI, didn't mean to call you out there. But what I'm saying is, you see these moves, and it's a Friday. You got risk ripping, and you got all these yen pairs are moving up and towards resistance. And I have to say that sentiment is extreme across the board, but it can stay extreme, and we could probably stay in that way into early next week at least. And that's kind of the way I'm looking at it. Yesterday, I had some heartfelt conversations on the morning edge, and if you guys don't subscribe to, oh shoot, do we have data coming out, Stelios?
No.
Oh, no data. Okay,
it's Canadian, right. But
we have confidence.
We have a guest.
Oh, we do have a guest. Okay, I just want to say that if you don't come in and listen to the morning edge in the ForexAnalytix community, you should. We break down like all the different markets, and it's private for our community. And the morning edge has been going on in one way, shape, or form literally since I started broadcasting in 2001, when it was an audio broadcast only, and it was it was literally it was a 15-second internet delay. and it was, you know, only audio only, but we, you know, it's evolved over the years in one way, shape, or form. And right now we have it in the ForexAnalytix community. So make sure you guys come in and listen to that, because that is a private, you know, private show every day. Yeah,
Baby face,
this is 2000. Whoops, that I didn't want to do that. This is 2005. 2005.
Who thinks Blake would look better on Fox or on CNN?
Oh, come on now.
All right.
Come on now.
For the Playboy channel.
Put me on the, yeah, there we go. Now we're talking.
All right, yeah.
But that,
I thought
that
Steve
show,
would say that.
that show we go through.
You see the effect I have in the team, right?
Yeah, I do, man. It's very positive.
Well, we go through all the different charts, and Steve and Stelios get to take you in deep diving into some of these themes that we talk about here, we brush on here. So make sure you guys you know, take advantage of it in the ForexAnalytix community. You know, you can join right here where it's, you know, we have our little links, they pop up. And all of you that are in the ForexAnalytix community obviously get emails every day. So, Dale, I know you have an interview coming up. I want to say, for me personally, it was a really tough week. I got, you know, there are weeks that you get put on the wrong side of the market.
Can I say it, Blake?
Yeah.
I hate the business this week.
It's a love-hate relationship, right? It's like when you're playing golf and you're like shanking all over the place, and all of a sudden you chip up and you're like two inches from the cup, and you're like, oh, I love this game. You know, trading's the same way. Trading's the same way.
That's why I don't play golf. I'm aggravated enough in the market.
Anyway, I want
to go ahead.
I just want to thank the team, because Ryan, Kman, Stelios, Steve, great. I mean, in our chat rooms, really great coverage of all of the events this week. It was a mayhem week in the markets. I'm glad that it's over, and I'm looking forward to enjoying my weekend, and I know you guys are too. But we do have a guest here, and I know Dale's going to take us through, and I want to say, Dale, we appreciate you, and have a great broadcast have a great interview, and thanks, team, for another great week.
All right, Joseph is the new guest, and I want to wish you guys a happy Father's Day, and to
thank you,
and to all the people that watch us and attend. Happy Father's Day. It was your best trade you ever made. All right, Joseph Barbudo, really a pleasure to meet you. Thank you for granting an interview and coming in to talk about the long E-wave with us.
Yeah, thank you. Can you hear me all right?
Got you, Joseph. Yeah.
Good.
So did you bring any visuals of your work? Or you just wanted to talk?
Well, I think it's a talk, and listen, if they like what I have to say, we could always follow up in the future. And I'm still getting acquainted with Zoom. I don't use it that often, so.
Okay, because there is a screen share function.
Oh.
There is a screen share function in Zoom. So, you know, I'm a believer that a picture speaks 1,000 words, but we could we could just move around and talk about different things. Why don't we start with why don't you tell, you know, I read a bit about what your story is, and you know, it sounds familiar to the story that Luke Roman had. May have been a different time period, but it involved having bad timing buying real estate. And that drove you to saying, you know, I need to make better decisions. I have to know about cycles, and when's an opportune time to do it, and when's a good time to sell. So how did you come across the K-wave?
Oh, this is by accident. So let me articulate my history, because I think it really puts a framework in how I think and view things differently. So my story starts in '89. I proposed to my wife at the time, of course, on Valentine's Day. I remember the date, February 14th, Tuesday, and the real estate markets were hot in Toronto. So we bought from Toronto, Ontario, Canada, and that weekend, that Sunday, we bought a condo, and unknowingly, I bought right at the top, and we had a really bad bear market for 4 years. At the same time, I also started the investment business in '89. And when I started the investment business, I learned very quickly that they wanted me to decide, as I built up my client base, how to allocate the assets. Well, I said, I have no idea. What am I going to do? So I just learned from the best. And at the best were John Templeton, Peter Cundall, and Charles Brandeis. And these were the greatest value managers of the day. And this was the early 90s. So my first 10 years was really managing private wealth through a value approach. And I got the opportunity to meet John Templeton and Peter Cundall, and I just picked their brains. I mean, how do I decide what to allocate for clients? And I loved Templeton's approach, you know, buy low, sell high. Didn't know what that really meant at the time, but I was buying things out of favor, and whatever was hot, I was switching out of those accounts. And I got into trouble with compliance. You're actively moving the accounts. I said, well, twice a year is not active trading, but I did extremely well for clients, and they were happy. Then I fell into the long way when Harry Dent came out with his book, The Great Boom Ahead. And it was kind of my first introduction of the...
That was his first and last good book.
Yeah. Well, I'm going to... It is
still read. Yeah, let me ask you something. You still read his stuff, and did it have influence in keeping you bearish the last 10 years?
No.
Because he has been.
He's been very bearish, but
10 years.
Yeah, for a long
10
time.
years.
And yes, for a very long time. But there was it was an introduction to the long wave.
Okay.
And
demographically, I mean, he was a big demographics guy.
Well, demographics is important, but it's not the only thing.
Okay. Well, I think most people are familiar with Kondratiev.
Yes.
And it's a 70-year cycle, right? Or
yes, there's no exact time frame. And actually,
where are we? Isn't it winter?
Fall. We're in economic fall. Actually, and I'm looking
fall.
At fall. There's 4 seasons. I just posted. Interesting enough, my website was launched today, so I'm a big picture guy. And if you go to my Twitter feed, you can see the link to my website. It's economiclongwave.com.
Okay. Yeah, I pulled it up here, Joseph. So
thank you.
So I can make a nice commercial for you.
So
and give me your address and I'll send you the bill. All right, go ahead, buddy. There's Joseph, handsome guy. Marcus haven't really, aged you. Yeah, you're weathering being a trader pretty good, buddy.
Well, the difference is though, and let me explain.
Yeah, you're not a trader.
You can understand where I'm different. In the 90s, as the internet revolution was starting, I stumbled onto a long waves forum because I was hearing this man called Richard Russell. I'm sure everybody knows.
I know, sure. Yeah, La Jolla.
Yeah, and so I found the Dow theory fascinating. I found the long wave fascinating. In my mind, it made sense of the world. I thought it was a chaotic thing that just grew linear. But the more I learned, but you're
breaking up on me a little bit.
Many interpretations, and on the long waves forum were hedge fund managers, money managers, writers, traders, brilliant minds all over the world. I was just absorbing stuff because I'm just a curious guy by nature. And I started making pretty good predictions, but this is my first folly. So here's my second mistake, financial mistake. I went bearish in 1998 in the markets, and I was pulling clients out. And remember, I'm a mutual fund advisor, personal wealth, so I was allocating assets. And I got a call from the compliance office, and they said, "What are you doing?" I said, "I'm moving everybody out of the market. We're going to have a collapse here." This is 1998.
Yeah.
He said, "Okay, come in," and went in to see him, and he closed the door. I thought, well, I'm going to get fired here. And he said, "Look, I agree with you, but you know
Keep
what?
your clients happy, and they're missing everything, and
Yeah, they're missing everything.
and they're
It's just like-
pissed.
but he said, get it signed, because at the time I didn't have to sign the trades. And long story short, he's an actually an Elliott Wave fan. And he introduced me to Elliott Waves, and I found that fascinating. Well, it was a tough 2 years. Eventually, I was right in 2000.
Do you
and lost
think, does it have any similarity to what probably a lot of investment advisors after COVID and you know, the Fed raising rates are underinvested, and their clients are saying the market's going without me? Is this a similar time frame? Does it feel like to you?
Okay, from the Canadian perspective, you know, what I do is the markets are bearish. And interesting, the models that I have, it's bullish on the US markets. And this service, whatever. So I'm more of a long-term, not a day trader, right? So I'm just going to tell you.
Well, then tell us what your long-term outlook is then.
Well, I'll say is I'm looking for economic winter to appear post 2024.
Post, okay.
Yeah, because
All right.
we even have China turning down, Europe is turning down, US is turning, so is Canada. So there's a, you know, I mean,
What about Europe?
Europe, yes, Europe is turning down. Interest rates are rising. Real estate has peaked. New housing construction is slowing. I mean, these are precursors to a hard landing. They're not appearing yet, but that'll start appearing this fall and next year.
Okay, next year.
Definitively.
I think Gann has 24 as a negative year. So how do you position yourself in the fall and prepare for the winter?
Well, what I combined is in the 2000s, I learned technical analysis and money flows. And I learned from Martin Pring, because Martin Pring has the only active I'm aware of long wave model. And it's a phenomenal book. It's actually on my list of resources. So if you want to look at books that I've read and used, I said, hey, why don't I make a Canadian version? So I did. And his track record is phenomenal. And it's more for wealth management, right? Protecting your assets. So since I'm not a trader, I'm just riding the business cycle.
How do you ride a business cycle? Do you just sit in cash?
Right now, I'm 50% cash. Yeah, 50% flat.
Where's the other 50?
30. Well, I have 30% inverse.
You know, Joseph, I feel like a dentist right now. Okay.
Why?
Because you know, I'm trying to extract some things that, you know, people could plug into their narrative, because we're investors too. We're not just day traders. We invest too. So I brought you here to share what the long E wave is saying to you now, and how we can prepare based upon your work in the markets. And I feel like you're really not willing to go there with me. If you're not, and you want to keep changing the subject, that's fine. It could be fluff. But, you know, to me, time is more important than money. Okay, so you know, I want people to be edified. They can watch an infomercial anywhere. You know, I want to know what the E wave is saying right now, because if we're close to winter, people should prepare for winter. And
well, what I have,
yeah,
I'll tell you what I have. So that's what you want. Sure. Right now, 50% cash, 30% inverse at the TSX and also banks, and a large holding gold and silver. Max. That's my best trade. When Richard Russell, I remember in 99, 98, he said to buy gold and start accumulating. And I started actually at the bottom. And when I left the investment business in 2012, I said to clients, hold on to that and keep increasing your positions. And in Canadian dollars, it just hit a new high. So I'm overweight in gold, in cash. And that could change in September. The model could switch back into the markets. But that's for this year as of today.
Okay. All right, appreciate that. And so the way to, and in winter, don't you think those positions that you have will be even more validated than they are in the fall?
Well, economic winter will favor traders because of the volatility that's going to come. And I will trade the business cycle, the 3 to 5 year business cycle. So at the bottom, I'll be deploying assets, right? It's what Templeton taught me. So right now, market's overvalued. We're going into a recession, maybe a hard landing. And so I want to have a lot of cash. In the day, Templeton, Peter Kondo would hold 50% cash in their funds. That was the norm back then, which is almost unheard of today. So that 50% cash could be deployed this fall if the markets provide assets cheap enough. Okay. Templeton always emphasized never overpaying for an asset. Never.
So it sounds to me like you're expecting at the minimum a correction in the fall.
Yes, if you scroll the All Season Investor, that's a book that I've just emulated for like building a Canadian model, and it's just allocating where we are in the business cycle. So of course, as the business cycle ages, you start taking some profits, and you start increasing the cash position. And then, of course, when you get a downturn and you get all the signals that the markets, all the sellers completed selling, you're the buyer at the bottom, doing the opposite, but using technical analysis, value investing, the business cycle, the long wave, and most importantly, the real estate cycle is the most important lead and indicator, which a lot of people aren't aware of.
Okay. Well, let's talk about this a little bit because, that was one of the areas that the Fed was targeting. Okay. Right. Even Powell told the millennial, don't buy now. I would wait. So that was at the beginning of the campaign. And now we're in a pause and real estate values actually are appreciating. Only this time, instead of being able to get a 3% mortgage, it's a 7. And it's really a housing stock situation that's keeping the market up. How do you solve a housing shortage with higher interest rates? Do you think that it's a mistake, and do you think real estate eventually will crater and be as bad as 08?
Are you aware of the real estate cycle, the 18-year real estate cycle, or the Cousin cycle?
No.
Yes?
No.
Oh, it's part of the model. I'd love to bring that on. We could talk about it next time, but the real estate cycle, you can Google it and inform yourself, and it's 18 to 25 years, and it follows a clock pattern. And if you look at that clock pattern, we're at about the 18th hour where the sentiment is still bullish, but prices are now falling. Even in the US, I think the Case-Shiller prices are falling. So, and with rising interest rates, that's negative for real estate. So and real estate and the financial cycle are turning down, which is also warning us that things will start to unravel over the next year and a half. So I'm very bearish on real estate in the developed world, because if you look at building permits and all that, that's rolled over. But there's a great book. If you want to be a successful, and I wish I had access to this book, it's 18-year, I think, real estate cycle. I should put it up there, but it's warning about real estate. And here's why I'm worried for the US. Last time they were able to bail out the banks, and it will be an issue. Can you bail out the banks and the economy now? This bubble is larger in the US than it was in 2007 in terms of values, but we don't have an interest rate cushion. This cycle was the first time in history that society is leveraged from the zero bound. That's never happened in history. There's no recorded. Bubbles have always burst around 6%, and there was a deleveraging. We've never really had a deleveraging. So that's what I'm looking for. And
people in their homes now, there would have to be massive unemployment because they can't live cheaper than their 3% mortgage. They're trapped there. There's nowhere to go. They can't rent cheaper. They can't buy cheaper. The only thing that would make them put their house on the market would be a foreclosure, right?
Right. And how many Americans, I think, lost 10 million homes in the crisis? So, and this one is more concerning because of the level of leverage. There's a great book I just finished, The Price of Interest, by Edward Chancellor. He wrote another excellent book, The Real Story of Interest, sorry. The Price of Time, The Real Story of Interest. Unbelievable book and kind of terrifying to think, what kind of model do you, when society leveraged from zero, because my experience from 89 to 94, what saved me from bankruptcy, even though my condo collapsed 50%, is interest rates fell. So I was able to carry the mortgage until I paid it off. How do we soften the blow for Americans, Canadians, those in the UK and Australia as this massive real estate bubble around the world unravels? I don't know. This is new territory.
Okay. Do you think that we're in a bubble in equities right now? Look at this parabolic move that we've had in S&Ps and NASDAQ. Or the bubble in the fall, the bubble could keep growing until we enter winter.
I am the one that believes that the bigger bubbles in the bond.
Okay. Okay. So you're looking for sovereign
That
debt
capital
crises.
is not getting adequate return. And so it's going into equities.
Okay. All right. And it looks like they may not be getting, they'll be getting less adequate return because the bonds look constructive for a bear market rally to me. I think maybe that's why the Fed took a pause so his buddies could lighten up on duration, have their portfolios look a little better. So yeah, this was I've never seen this in my career. I've been around, I think probably, around the same time as you've been around. So you're still bearish bonds more than stocks here.
Yeah,
right?
I'm much more. I have no allocation to bonds, zero.
Okay. Okay. And what about the miners? If you're a gold guy, you probably have played around in the miners. Can you explain why we had, like, maybe we'll have a good day today, but a pretty good day and silver's been acting okay. And then you look at the miners, like here's a SILJ, it's the juniors, it's an ETF, or we could even go to GDX, and it doesn't look great compared to what gold and silver did yesterday. Why are the miners lagging, and were you taught that the miners should lead?
Oh, there's yeah, that's a tough one. What I understand, because why there's a bull market and gold and almost all currencies now, and in Canada, Canadian dollar terms, they hit a new high, but it's not falling with the miner. I believe that you're going to get that breakout when the economy and the cost for miners falls, and that's a hard landing, and gold prices stay up. And that difference is going to help the bottom line of gold and silver miners, which will propel the bull market. So I'd be adding to positions, and that's just a long-term thing. I've agreed in principle. What I've learned from Richard Russell was that the danger is the currency into the futures. Governments are going to continue to print and prop up, and they need inflation. So that's how I see it.
Okay, so which currency are you more bearish, the dollar or the euro?
Oh, definitely.
Fiat. You're more bearish euro?
Yes, definitely. I mean, the US will be the last currency standing. So I'm still bullish with the US dollar.
Okay, so I've heard people like Martin Armstrong say that the sovereign debt crisis starts in Europe, migrates to Asia, and then comes to the US. Are you in agreement with, that's kind of the way the pattern will go? Europe first, Asia second, us last?
Yes, because Europe has had 1, 2, 3 recessions since 2008, and
Yeah.
it's the demographics is it's following Japan. The demographics is very poor. You have these obligations they're trying to meet with a population that is aging rapidly. I mean, all of the developed world faces that.
Yeah.
But yes, and the structural weakness in now with rising interest rates, it's just going to cause cascading problems. I think we're in the 2007 period to today. Everybody's saying, well, it's a soft landing. Everything
Yeah.
looks okay, but
Yeah.
markets are telling us a story that no, it's not going to be okay next year. So I see the hard landing next year.
Okay, why don't we wrap it with the banking crisis? Everyone's forgotten about what happened to the regionals. The big guys don't look much better. You said that you're short banks. Is that true? Or
Yeah, inverse for clients who
inverse?
want to take that
Yes.
position who are aggressive. Yes.
So XLF, what's the inverse? What are the inverse bank put ETFs that you buy? What's the name of one?
Oh, I don't know that. There's a financial site. It's in Canada. I'm in Canada, remember? So it's an inverse
Okay.
the financial sector.
Okay.
I have the name in front. I forget the letter, but we just have Horizons. Those are interested. Horizons have launched a double inversion ETF for Canadian banks. So you can go to Horizons website.
Okay. So
And
here's
if
the
you're an
XL.
aggressive trader, yeah.
All right, I wanted to ask your impression of this. So these are the big guys, the Bank of America's, JP Morgan, which doesn't look so great itself. And they're the so-called beneficiaries of regionals folding, all the money going to the big five. But the charts are pretty similar, except for the magnitude of the decline. Do you believe we're still in a global banking crisis here? And if you think real estate's in trouble, do you think that there might be a rule change about how much money you could withdraw from your account to help stymie rapid withdrawals and putting banks in the same position all the regionals were in?
I would, yeah, the concern is the story is the leveraged real estate markets in the developed world that are now all rolling over. And that will set off the other crisis in 2024 because it's the leverage and the leverage from the zero bound that every society. So that's the storm that I see behind us. And we're going to see the crisis enlarge into next year. It's pretty obvious from history that the models, that's what is telegraphing. It's that it's getting worse, not better. And I follow the top leading indicators in the world, and none of them turned up. Europe has turned down. China, oh, by the way, China's turned down for the first time since really 89, a real recession. They bailed out the world last time. That's why.
Right. You're right.
Right. And Canada and Australia and China never had a crisis. Our real estate markets kept rising because they repowered with a commodities boom. We had interest rates collapse. So that's why Canada looks unscathed as on Australia. It was China that bailed out the world. Now, if they go into a hard landing, Europe, United States, how do you bail out the system? So these are the indicators I'm looking at.
How about with digital currencies, CBDCs?
I think that they're going to fail in the end, and they try to force it on society. I'm in the belief that it will cause a revolution.
Amen.
A popular uprising, as Bob Hoyt says. The public won't accept it.
All right.
Is that a nice way of saying it? Popular uprising.
Yeah, it's a nice way of saying, have your bunker ready. So just like Yellen's code word for more failures is consolidation. Anyway, John, I'm glad we had a chance to talk, and you survived my grilling, so you're now my trading warrior, brother. Huh?
No
See,
problem. At
he-
least I will be more prepared.
You're
I would
tough.
love to do it again.
You're tough. You showed it, man. You know, I just would love to see the visuals and things that give you this view. And
Sure.
here you can follow next time, and you could go check out John's website. He has services. What do you have? A newsletter, Substack?
Yeah, I'm on the Substack is free articles to educate people, like free. It's just the long way. So I'm educating individuals, and then the subscription is for people who want access to the model. That's it. It's just a tactical asset allocation model based on what I've learned from Martin Pring. There's nothing genius about it. It's just simply buy low, sell high, and using his phenomenal indicators to allocate. So it's, and at most you'll be allocating 4 times a year. It's very inactive as possible.
Okay.
Purposely designed that way.
He has different phases of the economy too. Where's he at right now?
Martin Pring?
Yeah.
His models, I've read his stuff lately, and his US models, he's believing that a secular bear in inflation adjusted terms is about to unfold, which is going to favor traders and more active investors than buy and hold.
Oh yeah.
That's his big macro thesis.
Okay, be tactical.
Yes, tactical, static investing and buy and hold will probably not work in economic winter, but I was surprised with that piece. And you could go to his consulting services, and it's dedicated, directed toward Americans, and specifically the allocation, the bigger pictures, inflation adjusted terms. He sees a sideways movement in prices, for a secular bear. So that means the active investor will be much more successful in preserving and generating wealth into the future.
Okay. Joseph Barbudo, and you can follow him at the E Longwave, at the E Longwave on Twitter, and check out his website. And really appreciate meeting you, Joseph, and you giving us some of your time on a Friday afternoon. And
thanks.
Yeah,
let's do it again, and I'll bring the charts on whatever you want. I've got thousands of macro charts, and if you want, actually, you tell me what you want and tear it apart. I got no problem. I look better.
No, I just think a picture speaks 1,000 words. So
sure, we'll do that next time. Promise that.
All right. Thank you very much, John Barbudo, everybody.
Thank you.
Have a great weekend, everyone. To join the team, and
happy Father's Day too, please.
Oh yeah, you too, Joseph. Laura's thanking you. People liked our little discussion, our conversation, Joseph. So have a great weekend, everyone. Don't just count your pips, count your blessings. Be back with you Monday. Get some rest. I don't think it's going to be a dull summer. The solstice is next week. And again, happy Father's Day to all the dads out there. Adios. Thanks again, Joseph.